Let's start with Cyprus. Not that we complain about the amount of attention spent on such a small economy, not that we criticize the dysfunctional decision-making in the Eurozone. Actually, we find the structure of the bailout program quite consistent with an orderly resolution of issues at hand. Insured depositors are safe, and uninsured depositors, beyond the 100,000 level, contribute to the solving of the problem. Taxpayers are safe, and the state pension fund untouched. If the Cyprus lessons bring citizens and investors to be a bit more diligent when they choose a banking relationship, we think it's not a bad thing. Coming back to markets, neither inconclusive election in Italy nor the start of automatic spending cuts in the US did trigger any meaningful correction in equity markets. This has to do with the admirable strength of the US economy, with recent economic and employment figures coming in well above our and market expectations. The Fed reflation strategy is bearing fruits, as evidenced by near record high stock prices and a housing recovery in full speed. We expect a kind of pause in the second quarter, but for the second half and beyond, we expect the US economy to regain momentum. In contrast to the Eurozone, where recent economic figures have been dismal, the US is benefiting from increasing and cheap energy supply from unconventional sources. We expect the US to reach energy self-sufficiency by 2020, and as a result, the current account deficit will most likely disappear. This speaks for long-term US dollar appreciation, especially as other currencies such as the yen, the pound, or the euro have serious issues. Our portfolios are broadly neutral versus risky assets, with a strategic overweight in emerging debt and high-yield corporate bonds, and a strategic underweight in low-yielding safe haven government debt. Within the equity bucket, we focus on high-conviction themes such as US housing, US banks, and smart resources. While we expect equities to outperform bonds in the medium term, current valuations are not particularly attractive in absolute terms. We remain disciplined as to entry points and keep cash for opportunistic investing.